What is up, my friends? What is up? It has been approximately 7 or 8 months since I last made a video regarding the SPX gold ratio, which seems to be the favorite of you guys out of the videos I've made. Um, it was titled The Most Important Chart in Your Trading Career, and I still view it as that way. On the chart here, you see in orange that SPX gold ratio. The white line is the industrial production. And at the bottom, you'll see the rate of change for said industrial production. I've made a bunch of annotations on the bottom of the chart, and we're going to go over some cycles right now. Now, these are longer term cycles. There's a berry cycle, which lasts approximately 30 years, and it's made up of 3 Juglar cycles. Uh, I'm sure I butchered the name. It's a French guy, but long story short, 3 Jugglers make up a berry. 3 berries make up a larger cycle, which I won't get into right now, but over the course of our trading careers and our life, we're probably only going to trade a couple of these cycles at most. Cycles are made up from bottom to bottom. Um, and the berry will feature 3 Jugglers, as mentioned, a transition and innovation, and a disruption cycle. Now you'll note here on the chart that when we enter a disruption cycle, that SPX gold ratio tanks. Disruption cycle tanks. So you spend about a decade just dumping with relative pricing against gold, that is. Now, nominally, the market may appear as if it went up. It might go sideways. But as I showed in the previous video, moving to gold in a situation like this, or more specific, an asset that is viewed as safety, which Bitcoin may or may not qualify for now. Trump just had a speech at the Bitcoin convention and brought up that if he's president, he will make a strategic Bitcoin reserve. So we shall see. Time will tell. But I digress. Back to the cycles here. If we use a Fib Time tool, we'll note that these smaller juggler cycles, you generally have the transition cycle and the innovation cycle display approximately a one-to-one relationship. So once we get that first cycle, we can pretty much get a rough estimate of when we're going to hit that disruption phase and the market's going to blow up on us. I'll do the same here. And you can see that one was quite accurate for the 80 to '09 period. So if we do that for the cycle we're in currently, we just finished up our transition cycle, and we would anticipate that our disruption is going to begin somewhere around the end of this next decade, right around the 30s, which seems to make sense. We had the roaring 20s back in the 1920s, and it led to the Great Depression. So I would not be surprised to see something similar occur this time around. Um, our recent cycle is a crisis cycle on the larger cycle that is 3 berry cycles. You have an adaptation phase, a regeneration phase, and then a crisis. So you're looking at a disruption cycle in a larger crisis cycle. That could be pretty devastating. I'm not going to get into what I think will happen on that crash. That's for another video sometime. But as I said, um, you're looking at a crash nonetheless coming up. If we anchor the 382 to the first portion of our juggler transition cycle, it can give you an approximate period for when we can look for the markets to start turning around and possibly seeing an end to this disruption. It's a really large macro cycle, so obviously you have to give it some leeway. It's not going to pinpoint the bottom quite as accurately as the one-to-one relationship on the juggler cycle. It was a bit closer here. You can start looking for deals in the market. We're about to begin a new transition, etc. Looking for larger changes, maybe looking to see what the new late great disruptive technology is going to be. It's AI this time around. So that's telling us that the end of this decade, we're going to see a nasty crash. And it's probably going to take us till the late 30s before we start seeing our way out of it. Um, so, yeah, that's a little bit about the larger term cycles I wanted to go over that play into this SPX gold ratio. Um, one thing you can count on is the government to kick the can down the road further if they have any opportunity to do so. I know the Fed likes to talk about getting interest rates under control and inflation under control, and they want to help you. They have no choice. They're going to inflate the debt away. The debt to income on public debt is 120 some percent of GDP. They have to inflate that way away. They're not going to use austerity. They're not going to cut military spending. They're not going to risk public uprising by cutting Social Security and social services. So that only leaves them with either destroying the system and saying we're bankrupt, it's over, which they're not going to do, or inflating it away. So that's exactly what they're going to do. And in that inflationary period, you're going to see risk assets, uh, real estate, equities, things of that nature, boom. So it's not over with yet. We can see that the rate of change on industrial production has started to tick up the past month or two. So we're getting ready to start another leg up. I see this as being similar to back in the early 90s. We're in this period right here. Same as we're probably in the early 60s period. So you have this run up coming ahead of us. Um, so as always, I recommend consulting the SPX to gold chart, keeping an eye on this, and you know, don't panic. You'll have an opportunity to get out coming in the end of this decade. That's not to say you're not going to see 10 to 15% corrections. That's normal. Those are buying opportunities. As things are getting crazy and peaking and then start to roll over, take a little profit. Don't cash out the whole account. You should never be 0% in equities and 100% in gold. It's all about ratios, as I mentioned in the first video. You know, uh, maybe you take 10, 20, 50% off and buy it back as it's dropping down. Again, I think we have the rest of this decade before we really see the wheels come off of this bus. But time will tell. As always, good luck, have fun, practice solid risk management, and thank you for your almost 9 minutes.